Microsoft Teams at work. And so this is just a different instrument. Okay, tonight we're going to discuss term insurance versus whole life insurance. Okay, so with that, I'll go ahead and get started. I wanted to just show you this graphic because it really is quite mind-boggling for those who don't know it. It's called the theory of decreasing responsibility. Have you ever heard of it? Most people have not. Yeah, but it really is what insurance is all based on. Because if you look at the left side, you can see that's money, and then the right side or the bottom is time. And even though I have 1 through 9, just think of that each one digit is 10 years or whatever, or 5 years, whatever. It's just a representation of time. So you think about it, as we all start off in life, we leave home, we start working, and guess what? The bottom line shows in red, we have no money. We're in debt. We're in college or we're going to school. We have no money. We're starting our work career. We have no cash, but as time goes on, if you build your cash, remember in our first seminar where we talked about the rule of 72 and that how you can increase your, using compounding interest and grow your money. So that line reflects a person who's doing that, a person over time who's investing and saving, and their money and putting in the right instruments will combine, and their money will grow over time. The other line shows your liabilities, your responsibilities. That's why we call it the theory of decreasing responsibility, because let me just show you the next slide here. Here we go. Because this is how life works. You finish high school or college, and what happens? You're in your 20s, you meet that other person, you get married, and you have a spouse now, and then guess what? You want to have a home, so you get a mortgage or you rent an apartment or whatever. But let's say you have a mortgage, and then guess what? Life happens. Children come along, and now you're in debt. I mean, that's just how life happens. But guess what? At the same time, you just started working. You might have a good job, but yet you really don't have any cash. You're broke. I mean, you're living check to check. You don't have any extra money. You might have enough to pay the rent, the mortgage, and take care of the children and the child care expenses, but you really don't have any savings. And so the thing about insurance is that if you were to die prematurely, your spouse would be left with a mortgage, children, and all this debt. And so insurance is a great idea when you start out. Everybody needs it. So that top line represents the need for insurance. You need insurance. Indeed. And so what kind of insurance do you get? Whole life or term? We'll talk about that. But in any case, you do need insurance because let's face it, what is insurance anyway? Is insurance going to protect you from death? Is it like a cloaking device that's going to save you from that car accident? No. What is really insurance? A lot of people don't really think about it, but the truth is insurance is income replacement. It is to replace the income you would have made had you lived. Now, no one plans to die early, but we also need to be prepared that if you love someone and you have a wife and a child and responsibilities, and that if you were to die prematurely, you will leave them as the income earner or the income producer, you will leave them hurting. So a person who loves their family would seek to get insurance to provide that income replacement, because that's what insurance is, to provide the income they would have made had they lived. I remember when I was flying in the Air Force, I was at Dyess Air Force Base, and I was in the B-1s, and we were flying low-level missions at night. I went and took a 20-year term policy for $400,000 because I knew that if I didn't come home tomorrow morning, that my family, even though they would love me and miss me, that money would continue to allow them to have the house and to be able to get my children going through life. And that's what insurance is for. And that's why I had it. I had a 20-year term policy. And I was very prudent and I chose term because I believe in investing in term because it's so much cheaper and it allows me to take that extra money and save it versus paying it in a whole life policies, because whole life policy is normally 7 to 10 times more expensive. So there, but so in my thinking in life, I chose term. And I'll go a little further in the presentation and explain why I chose that. But anyway, as getting back to this theory of decreasing responsibility, as you can see, when you're young, you got all this responsibility. But if you invest and save, and you see that line, that curve going up as time goes on, so you get 50, 60, 70 years old. If you invest in, guess what? When you are 70 years old, if you do it right, you've got cash. So your need for insurance, why do you need it anymore if you have the cash? The whole reason you got insurance was to provide that income replacement that you would have needed had you died prematurely. But fortunately, you didn't die. So if you live long enough, you will eventually, if you invest and save, will have income in your later years. Okay, I'm moving on to the next slide. So what the point I want to make out is my thoughts were in the way I was trained, because I was licensed to sell insurance in the state of Virginia. And so my theory is that as your money grows, your need for insurance goes down. So for example, if you look at year one, when you have no money and you have a house payment, a spouse and children, maybe you need 350, 400,000. So I can get an insurance policy to cover that need if I was to die. But as my money grows over time, there'll be a point where the lines will cross. And at that point, I no longer need insurance, because here I am now, 63 years old. I have the money. If I was to die prematurely now, my wife would just take my 401k, my IRA, my pension plan, and she would, so I don't have insurance. What do I need insurance for? I'm already got all this money. So she would just take the money, and she probably might be celebrating. I don't know. I hate to say it that way, but this is prudent planning. This is how life works. This is how life can work for you if you look at it. So this theory of decreasing responsibility chart is really quite revealing. It kind of shows you how it can work for you if you are saving. All right, I've said enough on that. 10 minutes have gone by. Okay. Now, remember my first lesson, I was talking about, the rule of 72. And again, I just wanted to emphasize, if you're getting 12% of your money and you choose to start putting it away, you can see 20, 40, 60, 80, 160, 320. So by the time you retire, you got 1.2 or $2.5 million put away. So what do you need a $100,000 life insurance policy for?
That's true.
You don't. So if you're doing the investments and making that money, the insurance kind of seems ridiculous. Why would I be paying $500 or $400 a month? Because insurance is based on your age, and the older you get, the more it costs. Yes. So why would a 63-year-old guy, for me right now, 63 years of age, to have a $100,000 policy would probably cost me $200 a month. That's just throwing away money. The reason I can say that, because I have money put away. But if I didn't have money, I wouldn't have any other choice, right? That's true. If I needed that, if I didn't have any cash, I would have no choice. So I pointed out. So you need insurance your whole life. Let's talk about that, because a lot of people buy whole life insurance because the insurance industry wants you to believe you need insurance your whole life. Well, I'm here to tell you that's not true. And as I showed you here in the earlier slide here, and I'll just show you, you don't need insurance your whole life if you are investing. However, if you're a person who doesn't invest, doesn't save, and you can see this lower line, they have a little money and they never, they might have 20, 30,000, but they spend it on new cars They keep it up. They never have a 401k. They don't do anything. So if you're that kind of person, you do need a policy your whole life. You do. So, I mean, a lot of people fall in this category. So there is a need for whole life insurance for people who either are not, who don't choose to invest or not able to invest. And there are a lot of people in this situation. So there is a need for whole life insurance. And so I don't down it. It's expensive. It's like 7 times to 10 times more expensive than term. And it gets more expensive as you get older. But if you haven't saved and don't have any income and something was to happen, that's your only source of income. So it makes sense. So, you know, I always say it's not that we plan to fail, we just fail to plan, because a lot of people just don't plan. They don't think about these things. They just go through life day to day and they don't think about any of this. They just go through life. And a lot of people fall in this situation. So whole life does make sense for a person who, you know, if you're 60 years old and you don't have $400, you need a whole life insurance policy, especially if you have a wife and children or people, if you want to leave some kind of inheritance or whatever for your children or grandchildren, you're going to need a whole life insurance policy. That's your only option. So oh, wait a minute. We have a person waiting in the room. I have to keep looking for that. It doesn't give me a beep sound, so I'm sorry for that. I hope they weren't waiting long. All right, so here we are now, and we talked about the principles of the theory of decreasing responsibility, and I think you have a feel for that, right, Veronica?
I do.
Okay, so now let's talk about what is term insurance, because I really recommend term. If you're young, especially if you're young, term insurance is cheap. It's, you know, whole life is 6 to 10 times more expensive. It allows you to get the protection that you need, because what did I say insurance was about? Income replacement. A person who's single with no home, no children, probably doesn't need insurance. Insurance is to provide protection for beneficiaries, for a spouse, and for children. So if you decide to get married and have a family and children, then insurance starts to make sense, especially when you're young, because you don't really, unless you're not a Donald Trump and you're not born with a silver spoon in your mouth, you're probably going to need some money. And if you don't have a lot, insurance is a cheap way to have coverage and protection. Yes. And so I highly recommend it. And I really recommend term insurance for that purpose, because it's cheap. I mean, you can get, if you're healthy, you keep your weight, because they look at 4 things. They look at your weight, your health, your age, and your sex. You know, those 4 things, you know, based on your gender, because women get a better deal, because women live longer. So the mortality tables are all adjusted. These are actuaries who actually determine these rates. But anyway, you know, so with term insurance, you can get a 10-year, 15, 20-year term policy. This will give you 20, for example, if you look at the 20-year, that gives you 20 years to start saving to the point where at the end of 20 years, I don't need insurance anymore. And if you think that way, term works great. If you're the kind of person who's going to get a term policy and does not save during this 20 years, that's kind of defeating, because you're going to need insurance afterwards. But if you do your saving and investing for the 20 years while you have your term policy, it will put you in a position where you won't need insurance later on. That's the whole thing. It's cheap, and it will give you coverage when you're vulnerable, when you're young and don't have any money. That's how it should work. So I point out this slide. I mean, it took a lot of work building these slides, because I really wanted to show a pictorial view of how it works. Because if your money is starting to grow, you know, your need for insurance goes down. Because like right now, I don't have a mortgage. My children are grown. They're gone. They've got their own jobs. My debts is minimal. So, and I've built up all this cash and then investments. So I'm over here in my 60s with I'm ready. I don't need insurance. So I dropped insurance 15 years ago. Well, I stopped saying, okay, I'm not flying jets anymore. I'm retired. I'm not at that high risk of dying. Of course, as I get older, my risk of dying goes up every year. But as far as other external factors, I'm not doing dangerous things anymore, flying for the Air Force. So my chance of getting killed in a B-1 is gone. So my risk of dying from that, of course, now we got this COVID thing going on. But still, like I said, at this point, my wife would just take the cash. She would take all my, joint accounts would just go to her, and she would be probably laughing at the bank. I mean, she would be just having a ball. I mean, she probably won't even drop a tear. I'm just saying that, but you know what I'm saying. If you're prepared for it, it's a beautiful thing. So, because it will happen. I know it's going to happen, and that's just how life works. But having term when you're in debt makes a lot of sense. But as you get older, if you start investing and doing that, you don't really need insurance your whole life. So the insurance, in my opinion, the insurance industry lies to people. They tell you that you need a whole life policy. And of course, there's different types, and we'll talk about that a little bit later. So what does insurance really do? Insurance is to replace income you would have made if you had lived. I've talked about that. So insurance is income replacement. I think I've emphasized that point. Okay, so what is whole life? Let's talk about that other instrument, whole life insurance. I don't know what you have, and you don't have to tell me, but whole life is very, very popular. I see it on the news, on TV all the time. They're always offering whole life insurance because whole life is different. It's insurance, but it also has this other feature called it builds up cash value. Being a licensed security agent at one time, I was licensed through FINRA. I'm no longer licensed. I gave that up. I just said, I don't have time for this anymore. I don't need the money. So I stopped it. But anyway, what I learned from this process is that the Financial Industrial Regulatory Authority, they regulate financial instruments like banks, mutual funds, stock investments. You have to be licensed through FINRA, is what it's called. But insurance is another set of laws. And so the insurance industry years ago decided we are making all this money on term, but if we could get people to give us their cash, we could make even more money. So they came up with this thing called whole life, where we get the insurance, but we get people to give us their cash. And we tell them about saving in an insurance. Here's a quantum thing. When you invest at a bank, you fall under FINRA. The government set up this institution to regulate and protect you, the consumer. So under FINRA, if you put money in one of their institutions, financial institutions, credit union, bank, a financial investment account, brokerage account, they have to report every penny that you deposit. They have to give you monthly statements showing where your money is. Not so under insurance law. So the insurance industry, they are covered by a whole nother set of laws in the United States. And so the insurance industry says, if we can get people not to put their money in a FINRA institution, but to put their money in an insurance, we can make a lot more money because we don't have to report to them what their money is going to be for every month. We can give them projections. We can do all kinds of things. We can take their money and do whatever we want with it. And we don't have to deal with the Financial Industrial Regulatory Authority laws. And so in whole life, it's a perfect instrument. They've created this thing with insurance and with cash value. It is a license to steal for the insurance company. So anyway, so in whole life insurance, you're supposed to be building up this cash value in your policy. And I don't know if you have a whole life policy, but if you do, if you look in the back, they don't show you your monthly deposits. What they show you is projections as to what your money would be doing over time. And if you notice, the first 3 years, there's zero value in the whole life policy. Why is that? If you're making $100, hypothetically, if you're making $100 deposits every month in a whole life policy, and you've been doing it for 2 years, there should be $2,400 in that account. But if you look at the projections in the back of a whole life policy, it's zero. Why is that? Well, the reason is because the insurance agent in a whole life policy makes 5 to 7 times more commission than a person who's an insurance agent that sells a term insurance. The reason I know that, because I was a licensed insurance agent. Because my average term policy, when I would write a term policy, I would make $300 to $500. But had I sold the whole life policy, I would have made $3,000. So you can see why most insurance agents want to sell whole life policy, because their return, they get paid the first 3 years of your payments as a insured customer is going to pay that agent the first 3 years. And that's why those projections in a whole life policy show basically zero for the first 3 years, because that's money is going to pay the whole life agent to sell you the policy. Now, who in the world would do that? I don't know, but people do it every day because they don't realize this financial system. But anyway, that's one of the things I don't like about whole life. But one of the pros of whole life, if you're not saving, it's a way to save money. And it's a way to have insurance for life, because if you're not saving, you're probably going to need insurance for your whole life. The cons are whole life insurance is 7 to 10 times more expensive. And you're paying for two things. You're paying for insurance and you're paying for this cash buildup. But the irony is you can only have one of the two. So if you, for example, let's say you have $20,000 cash in your whole life policy and you decided that I want to borrow that money. Well, you can write the insurance, say, you sure I have $20,000 I've been paying for 10 years. Let me have that money. Well, you're going to have to pay interest on the money. So is it really your money? Why would you have to pay interest? If you had that money in a savings account, you wouldn't have to, you go to the bank and get the money. Why would you have to pay interest on the money that's yours? You know why? Because it's really not your money. That's the game of whole life. So, you can only have two things. You can have a death benefit. If you die, you get the death benefit. Or if you cash in the policy, you get the cash, but then you lose your insurance. You can only have one of the two. So I don't think a lot of people understand that about whole life. So I just bring that out if you fall in that situation and you're considering whole life policies. Okay, and again, I just wanted to show this. You're paying for two things, but you can only get one. And in this example, I just showed let's say you had a $100,000 whole life policy. And so you've been in it for 15 years and then you got 25,000 built up. Oh, that's pretty cool. You got cash value. And they advertise this as if this is your money, like you can get it. But like I said, you can only get one of the two. Okay. There is no cash the first 3 years. And I pointed that out. Because again, I was just illustrating that money, the first 3 years goes to pay the insurance agent. A lot of people don't tell you that, but I'm Doc Lambert. I'm telling you the honest truth. I'm not selling insurance anymore. So, to be truthful, I never sold the whole life policy because I could never bring myself to take advantage of people that I care about, because really it's so much more expensive, but it is a need for it. I mean, every now and then I run into a person who doesn't want to save, don't want to invest. And so maybe a whole life policy does make sense, because at least this way they can build some cash value or do something, because the policy will make them save something. So it's not a bad deal. And I was just showing you here the difference in what the agent gets, $400 versus $2,500. So, I mean, it's the ugly truth, but I'm sharing it with Third Baptist. Okay. But if I had to choose between, on the right here, I'm showing a whole life policy, and then on the left, I'm showing a term policy. Again, a term is much cheaper. So let's say the person is 24 years of age. So at 24 years of age on a 20-year term, it's probably going to be, $26 a month if they're in good health, weight and all of that stuff. Versus a whole life, it would be probably 73. It's quite a bit more expensive. And that's how it starts off. And believe me, as time goes on, it gets even more expensive for a whole life. And again, if I like the term because I have my money, that the difference between $73 and $26 is money that I can be putting in my investment account. I'm not going to just, that's money I can save. So if I took that extra money and put it there, over time, that money will grow. And remember, we talked about compounding interest. It would actually be quite, as time goes on, the rule of 72, it would be in my advantage. And guess what? Both of them are mine. If I was to die with the term policy, my beneficiaries would get $100,000. And they would also get my investment account. So all that money would be theirs. But in the whole life policy, you can only have one of the two. Actually, I want you to make sure you understand this. Let's say that you do have a $100,000 policy and you have $25,000 of cash value build up. Do you get both of those? Does your beneficiary get, you just died, does your beneficiary get the $100,000? And because you had that $25,000 cash, did they get a separate check for $25,000? In other words, the benefit would be $125,000? No. Actually, they use your cash to reduce the amount they have to pay. So they only have to pay $75,000. They use your cash to pay the $100,000 benefit. Was that your intent, to subsidize the insurance company, to allow them to use your cash to pay the death benefit? A lot of people don't realize that. They don't understand that cash value is to benefit them. You're actually reducing how much money they have to pay if you die. That is such a well-kept concept and secret in the whole life industry. Boy, they don't want anyone to understand that, but that's really what happens. So why would you put extra money to reduce the amount of money that the insurance company has to pay? It's crazy, isn't it? Well, I mean, you're hearing it from me, but like I said, I sold this for years, and a lot of people don't know this, but so I'm sharing it with you. I'm hoping you're listening and following along. I know it's hard to believe, but this is really how it works. All right, so there's other kinds of whole life policy, and I just want to touch on them just briefly because I don't want you to leave you thinking it's just whole life. But this thing called variable universal life, and there's universal life, and there's all different types. But basically the difference is in whole life, when we're talking about the cash value, in the variable, they allow you to play with the money that you're building up in cash. Again, this cash money that you were building up, they'll allow you to play with it. In other words, you can put it in a mutual fund and you can designate the kind of investments that it's going in. They're trying to distract you on the fact that you all this money, but they don't tell you the fact it belongs to them, not you. Because if you die, you're just going to get the 100,000. You're not going to get this money at all. But they won't tell you that. They got you choosing investments, stock options, or whatever they want to say in their variable in policy. They got you all involved in that, but that's just how it works. Or there's universal life. Let me move ahead here. I think I talk about that a little bit too. There's different types. There's variable life. Again, they allow you to play and put the money in an investment or mutual funds or have a separate account. Now you have to have a Series 6 license to do that, which I had. But I've never sold universal life because I don't believe in whole life. I strictly sold term insurance because you can tell I'm biased. But again, there is a need for whole life for people who find themselves 60, 70, 50, 60 years old, don't have any savings, maybe whole life makes sense. So I'm not totally against it. There's a universal life. There's pros and cons. Universal life is interesting because it allows you to play with, I thought I saw someone pop up. Okay, sorry about that. Universal life allows you to allow people to play with the money, and you can change your monthly payments, your premiums, you can adjust all kinds of variables. It's really quite flexible. But in any case, that's universal life. And there's pros and cons. It's a lot more flexible than whole life. You've got a guaranteed level of premium for your whole life. You can adjust, play with a whole bunch of variables. I mean, there's so many ways you can play with whole life. And but I just share that with you because I think it's important. That's really what I had for a whole life insurance and variable life. I can answer more questions, but so at this point, I think I've covered what I really wanted to cover, which was kind of give you the main differences, and especially talking about the theory of decreasing responsibility. Make sure you understand, how life works and how insurance can be used to support, or, which way you want to go. If you're an investor, I would really recommend term insurance. If you're the kind of person who's, got a monthly allocation into some type of instrument, mutual funds, investments, whatever, brokerage, I think term is the way to go. There's a saying that we used to say at Prior America was buy term, invest the difference. Buy term is cheap and take the extra money and put it into your own personal investment. That's the best way, I think, if you're an investor. However, if you're a kind of person who doesn't believe in saving, you don't really think that's something you don't want to do or don't believe in it, then maybe whole life will work for you, but now you understand how whole life works. And so at this point, I think I've covered everything I really wanted to cover with whole life. I haven't heard any questions, but I will pause now and give you an opportunity to ask questions.
I just have one question, and I don't know what category it falls under, but annuities. Can you talk a little bit about those?
Annuities is just the opposite of life insurance.
Okay.
In life insurance, obviously you are putting in money to provide for your retirement, or you're putting in money in case you die. Where an annuity is really two types. There's an immediate or deferred annuity. Annuity is an instrument where it's like a pension plan. You put a bunch of money to burn down through your retirement. So it's a total different instrument than life insurance. Annuity is a pension plan. It's a plan where you can say, I've got 400,000. I want to set up an immediate annuity. Here's $400,000. I put in this annuity and I give it to an insurance company. And there's some really good tax advantages for that. One, you probably on a qualified plan, you get some tax deferment for doing it, but putting that money there. So annuity kind of makes sense, but but on the other end of the spectrum, you've lost control of that money. In most annuities that I've seen, there's a penalty for early withdrawal. So if you need that money, you won't be able to get it out of the annuity other than the way they pay it out. So there's a payment plan. Again, you put in a pension plan and they're going to set up to pay based on the Standard & Poor's 500 index, or however the index, however they make their payments, you're going to get a certain amount of money every month. And so annuities make sense. And I do recommend annuities in one situation only. And that's when, if you have family members that have longevity, let's say your grandmother lived to be 103 or 97 years old or 96 years old or whatever. You've got people in your family that live a long, long time. Then annuity starts to make sense. And what I mean, let me give you an example. If I had $500,000 in a mutual fund, and I took out, that's $500,000, and I took out $50,000 a year. In 10 years, that 500,000 will be gone. In theory, obviously you're compounding interest, so it might last a little longer than 10 years. But in theory, if you burn $50,000 a year, in 10 years, $500,000 will be consumed. You follow me with that?
Mhm.
Well, when that hits zero in a mutual fund, it's zero. They stop paying. But in an annuity, you're buying the name of that insurance company. You're buying, for example, Mutual of Omaha. You're buying their name. And so if you had $500,000 in an annuity, it will continue to pay even after it goes to zero. It will continue to pay your whole life. So now, again, these insurance agents, they're underwriters. They already know that you're not going to live that long. They're betting that you're not going to live but so long. But if you have a family that has genetic, y'all are long livers. I know some families that their brother lived to be 97, their sister lived to be 103. If you have family members with those kind of genes, I do highly recommend not 100% going in annuity, but maybe taking 10% or 5% of your portfolio and put in an annuity. Because if you put it in the right insurance company with a good name, and of course, Moody and Best, you want a A+ insurance company because you're betting your money on the credibility of this insurance company. There are insurance companies that default every year, you know that. So if you get a Mutual of Omaha or one of these top rate companies that have been around forever, then they're going to continue to pay. So an annuity, if you're looking for longevity, that is a good reason to have an annuity. Because like I said, if your mother lived to be 95 years old, believe me, if all you have is all your money in a mutual fund, when the balance goes to zero, it's done. It stops. So if you burn through that money, I don't care if you have $2 million. If you spend $100,000 a year, in 20 years, that money is gone. And if you're just 80 years old when you run out, that's it. But if you have a certain percentage of your money in an annuity, they will continue to make those payments even after it goes to zero. So that's one of the hidden secrets. That is really an incredible feature of an annuity. And I like that. And so, but I only recommend that really for ladies, because y'all live a lot longer than us men. You ladies who have longevity, your mother, your grandmother, your great-grandmother all lived to be 95 and 98 years old. You might want to put a percentage of your money in an annuity. That probably would not be a smart bet. But believe me, there's some serious penalties for pulling your money out of an annuity. So, if you need that money for something else in 5 years, do not be going in an annuity because they have some serious penalties. But if you go set this money aside and let it ride, and your family lives to be, in the 90s or whatever, the annuity is a smart play. So I hope I answered your question. But annuities, there's a lot more involved. Actually, I was selling annuities. They're very tricky and they have a lot of features and they're complicated. But if you take the time and study them, and if you have that genetic background of that, that your family, that you're probably going to be a long liver, that you're going to live a long time, 97, 98, 100 years old, annuity will be a smart play because you will never run out of money. They will have to continue to pay as long as you live. They might be wanting to send somebody over there to choke you out, but they're going to have to continue to pay. Whereas in a mutual fund or any other kind of financial instrument, when that balance goes to zero, it stops. So I really do like the annuity for that aspect. Man, my family, we live to be, well, my mother's 93. So I don't know. She's kind of changing the odds. Most of our family members die in their 70s and 80s. So, but my mother's setting a whole new trend. So I don't know. And I look like I have her genes. So I'm thinking I'm hoping that I have her genes. and that I'm going to live to 90 because I'm 63 now and I would like to be around another 20 years. But to God be the glory. It's all in his decision.
Amen.
I mean, I have no control of it. But if you look at your genetics, you might, I don't know about your family history and know that you need to share it with me. But annuity makes a lot of sense if you come from a family of long livers. There's a whole bunch of other instruments out there, but this particular seminar, I just wanted to talk about term and whole life, and annuities is a part of it. I could probably come up with another separate one, but I really already kind of told you the advantages of annuity. I mean, because they have to continue to pay as long as you live. And it's a really great feature. And oh, by the way, I mean, there's an immediate or deferred annuity. Those are the really two types. And then you can go into when it starts as an annuitant. They have these different terms they use. But they do pay, and you'll get a monthly, it's like a pension. They'll pay out every month according to their formulas, how much you get. You can set it where it's based on the Standard and Poor 500 index. I mean, you can set it up all kinds of ways. There's different kinds of annuities. So you can get into all of the details of that, but they will pay every month. And if you're a long liver, you can milk them. You can milk them forever. And if you live to be 98 years, they have to keep sending you that check. So, but again, these are underwriters. They're actuaries. They sit there and already know how long that they think Veronica is going to live based on your height, weight, and your family genetics. They already know that when they think you're going to go. So you're kind of betting against the odds. But if you, like I said, if you have longevity in your family, an annuity makes a lot of sense. And it really does. That, I mean, because that's one of my concern. I mean, right now I'm 63, and I figure that, by 80, I'm going to be gone. So if I retire at 65, that's 15 years that I've got to have money to pay in my retirement. 65 to 80, right? 15 years. So I need 1.5 million. That's my financial independent number, $1.5 million. Okay, and 1.5 million allows me to pull out $100,000 a year. Of course, I don't need to have all that because I'm going to get $3,000 a month from Social Security. I'm going to get another $4,000 from my military pension. So that's $7,000. So if I need $10,000 a month, I only really need $3,000 extra, to get me $100,000 a year, right? You see what I'm saying? So you can kind of do the math and figure it all out and figure out how much you need in your investment. So really, I'm right at my fin right now. I'm going to be truthful. I'm at my financial independence number. I could quit right now. And if Social Security pays out, I should be fine. I should be, as long as I don't burn over $100,000 a year, that's the thing. But of course, you have to look at inflation, things, as you can see with the Biden spending, things are going up fast. I'm sure you've noticed gas is going up. If you stop at a fast food, you can see fast food is going up. I couldn't believe I went to Chick-fil-A the other day and how much it has gone up. So inflationary spending, it really hurts us all, but that's a factor that you got to consider. $10,000 a day, it might take $15,000 to buy what 10,000 can buy today. That's what inflation does. So that $100,000, you can plan on $100,000, but 15 years from now, it might have the buying power of $50,000. So you might have to tighten your belt. So who knows the future, but I'm just saying, if you're smart, you'll sit down and figure out your financial independence number. We call it FIN. This is what they taught us in Prime America. And I would sit down with my clients and figure out their FIN number. and show them where they are and how much they need to save to get to their fin. And then when they get to their financial independence number, you retire. And then you step out and you on a budget, you say, okay, I'm not going to spend more than 3% per year. And so 3% of the money you have, let's say you've got 1.5 million, 1.5, 3%, that gives you, $45,000 a year that you can spend. And, if you got your house payment and, you can just budget it out, that might even squeak you out a vacation or two, and you just live within your means and you can go on through life. But the problem is, like I said, if I base that fin on 80 and I live to be 85, what happens? Because at 80, I run out of money, right? Not all of it, but because Social Security in theory won't stop and my military pension won't stop. But the other money in my investment funds, they've run out. So now I'm going to have to tighten my belt. So having an annuity is a really nice option if you're going to live a long time. And so who knows like right now, if I wrote down 80,000 and based my projections on 80, I might be wrong. I'm guessing. No one knows when they're going to die, so it's a guess. The last thing, the thing that scares me the most in life is getting old and remember we go to these assisted living facilities and sing in church for people. That's my worst nightmare, is to be in one of those places. I really do. I want to die at home. I don't want to go and have to be in an assisted living facility, indigent on Medicaid. That's a nightmare to me. I don't want that. I want to live in my home and die home in my own bed and around my loving family. I don't want to go in an assisted living facility, but that's me thinking. But everybody's different. But anyway, I've shared with you what I have for term insurance. You have any other questions? I was hoping to, I think I've covered it pretty good. I spent years getting licensed and studying and learning all the intricacies. I don't think you need all those levels of details. What I tried to cover was the principles to give you an idea about the theory of decreasing responsibility and how it works so you can make decisions. So you're a mature lady now you got a lovely son and family. And so this maybe help you in your decisions. And I hope that it's been a beneficiary to you. And maybe you can share it with your son, because he's the one who's probably looking at these decisions.
Indeed.
Do I need term?
Yes.
Do I need whole life? And you can use this information to explain to him the pros and cons, because whole life is very expensive. And it really doesn't make sense to have whole life insurance if you're an investor, if you're going to save money. But if you're the kind of person who's never going to save anything, then it does start to make sense. So, I don't know how your family thinks, but you can kind of figure it out and be able to advise them based on how they proceeding in life. Everybody's different, so I don't try to lump everybody. I listen to what people's needs are, and then I figure out which is the best financial instrument for them. I try to get them to do investments, because that's in the long term is going to be better off for them than a whole life. But some people just not going to save. They're just not going to do it, or they can't do it. They get, they're always in trouble. They're getting divorced. They're always in turmoil. They can't keep a job. So sometimes whole life does make sense, for some people. So, but if you're stable, got a good income, and prudent, and can understand these concepts, then term seems to be a really smart move for those who have the aptitude to comprehend it and the discipline to execute it. It's all about the discipline to execute it, because a lot of people talk the talk, but can you walk the walk? Will you go and change what you do as a result of this seminar? A lot of people I talk to, and I've done this for years, I will sit down and do a portfolio briefing with families, and they don't change. They listen to what you say, but it's really hard for people to change their habits. So, and to really do this stuff, you got to change, because